I'm going to look at a theme that we looked at in the fall 2023 time period, and it's playing out in real time here. We saw rate increases change the growth stock equation this past fall. After completing research for our cash-rich Canadian growth stock report, one intriguing theme developed. The research for this report includes literally manually screening through 3,500 plus Canadian stocks for profitability, strong net cash, which would just be more cash than debt, their balance sheets, and looking for growth. After looking at thousands of balance sheets and cash flow statements, it was clear that there was a significant post-pandemic rate increases. Those significant rate increases had changed the growth stock equation. This theme created a tremendous opportunity. Growth stock companies with net cash were positioned with a significant advantage. So I'll detail this for you right now. 2 to 3 years ago, a decent cash flowing growth stock could get funded or get debt for between 3 to 5% or lower in some cases. Today, if they can get it, they are paying 8.5 to 12+% in some cases. Their cost of growth capital is 3 to 5 times higher. So our thesis here was that strong balance sheets were critical. Growing net cash businesses were positioned well and should be rewarded over the next year. And similar over-leveraged businesses were in for tougher times. Now, I'm going to give a simple real-world example here. Let me give you this specific real-world example from our research, and it will outline and show you the success of this strategy over the past 9 months, which is a very short period of time. We'd expect it to play out actually over a 2 to 3 year period, but I'll give you an example here. The following is based on 2 real companies that we considered for recommendation in late summer, early fall of 2023, both profitable specialty pharma businesses. They were in licensing, acquiring, and selling unique drug treatments primarily within the Canadian market. I will simplify the 2 situations here for my example, but financially, the major difference was found in their balance sheets. Company A, $50 million in net cash. Company B, $50 million in net debt. Now, when that debt could be had for approximately 3%, we still preferred the company A, or the net cash company, over company B, the net debt company, paying only $1.5 million in interest. It was not truly affecting the cash flow or the business's ability to execute on its growth strategy. Today, with the debt costing 10%, company B is paying $5 million in interest. That figure has become material, and it's eating significant cash flow. On the flip side, company A, the $50 million in net cash businesses, for example, has no debt service payments, and as a bonus is now being paid, say, 5% or $2.5 million a year on that cash, where it was receiving effectively zero just 24 months ago. The net benefit could be, in this example, the cash risk versus the debt-heavy business is $7.5 million. $5 million, it is not paying for the costly debt, and $2.5 million in bonus interest. So company A benefits with a $7.5 million swing, largely by positioning itself with a strong balance sheet. But the benefits of a strong balance sheet don't just end at better cash flow. Growth businesses, by definition, these businesses are looking to grow. Highly leveraged businesses operating with one hand tied behind their back right now in a higher interest rate environment. As a result, they're less able to execute. Again, those benefits, the strong balance sheet in this environment, they don't just extend to better cash flow. All these companies are looking to grow. Like we said, highly leveraged businesses are operating, like I said, with one hand tied behind their back. So again, we talked about that. Now, net cash positions that have allocated or really have an advantage in this environment. And what they're looking at is they have great avenues. Sorry, I'm going to pull that back. They have great avenues to allocate that capital. They can create great shareholder value. Those kind of arrows in the quiver are share buybacks, dividend investing, or to invest in their own business or buying back other businesses to grow. Now, your question should now become, does all this balance sheet business make a lick of difference in terms of share price performance? In the investing world, it all comes down to returns, and the difference in performance between company A and company B could not be more pronounced over the past year. And they could really be just the tip of the iceberg for these type of companies. Now, this is my real world example. I'm going to get back to it. There were two specialty pharma businesses. Our research team sat down with management and reviewed both these businesses in the fall. The first company, Company A, the one we recommended was Cipher. It is a business that sells the number one doctor prescribed acne treatment in Canada. Cipher had a profitable core business, 50 million in net cash approximately. We recommended it at 389 in late August. The other company was Medexus Pharma, symbol MDP. It was another profitable Canadian specialty pharma business, then trading at $3. Now, since we recommended Cipher as a buy, the company has bought back over $6 million in stock with its cash on hand, added cash, and recently closed at around $9 per share. That is up 131%. On the flip side, Medexus, the debt-heavy company we chose not to recommend, continues to service that debt, and as a result is inhibited in its growth ambitions, closing recently at $1.60, down 47%. That is a massive 9-month swing between these two businesses. Warren Buffett once said, a rising tide floats all boats. Only when the tide goes out do you discover who's been swimming naked. We have witnessed over the past year and a half in the small cap arena. Solid growth stocks that have been disciplined cash accumulators are now in great advantageous positions to allocate capital. On the other hand, over-leveraged businesses can be in trouble. Now, Cipher currently ranks as a hold in our research after a strong run, but has solid long-term growth potential. We continue to favor strong balance sheets, often with net cash positions in many of the growth-oriented Canadian and U.S. small caps in our coverage. Finally, I'm going to tease one recent buy from our Canadian small cap recommendations. This buy recommendation is on a unique under-the-radar small cap that works with growth businesses such as DoorDash, Lyft, and Uber. This high-growth but low-price stock just posted earnings growth of 296% in its last quarter. The stock has already gained 20% since our recommendation, but with its growth profile, big name customer list, and strong fundamentals, this may just be the beginning. The underfollowed growth stock holds 85 million or $1.76 in cash per share with no debt. Based on our 2024 expected earnings estimate and removing the cash, the stock can be bought today at roughly 8.75 times earnings, a low multiple given the growth and strong balance sheet. This is another undervalued small cap with excellent growth that can be really found nowhere else. All right, that's going to close that out. Any comments?
It is. I mean, there are many ways that higher interest rates really do affect the growth profile of a company. So certainly if you have a lot of debt on your balance sheet, as you mentioned, if you're overly leveraged, then your costs increase. So obviously your interest rate increases unless you're on fixed debt, but then that fixed debt eventually will roll over. You'll have to renew it, likely at a higher rate if rates are still high. But just in terms of evaluating a potential growth investment, it essentially changes the numbers. So for example, if I'm a company looking to do an acquisition, I want to acquire something with a expected rate of return, internal rate of return above my cost of capital. Well, if my cost of capital goes up, then I need to get a higher rate of return from this investment. But that rate of return doesn't actually automatically go up just because interest rates have gone up. In fact, in many cases, if it's more of a discretionary style business or cyclical business, that rate of return may actually go down. So I know there's many companies out there that, they're growth by acquisition businesses, and people are wondering, well, aren't assets really cheap right now, given that interest rates have gone up? And of course, the reply is yes. I mean, there's a lot of acquisition targets out there, but they're relatively more expensive from a cost of capital basis because, we either have to take on debt to pursue those acquisitions, or in some cases issue shares. But if that company's share price has also been negatively impacted by the higher rate environment, then their cost of equity capital has gone up as well. So It's there's a number of different ways, even if you don't have a lot of debt on your balance sheet, how you can be impacted by higher rates. But of course, if you have net cash on your balance sheet, that's capital that you can deploy without having to, really be concerned about raising debt or issuing new shares. So it puts companies in a very advantageous
The other
position.
factor I would
Yeah.
add into that is when we had that super low rate period, we were seeing companies that were open to being acquired. They were asking maybe like 20 times EV/EBITDA, and now they might be at 12. But in reality, some of these companies, with even if they have cash, they already have the capital funded. They might only be wanting to pay 8. It takes time for those valuations to fall over time, and
Mhm.
across industries outside even the biopharma we've talked to is most of them are still high, but they have come down to something more reasonable. But it's not like this fire sale level pricing, which you would want for if you do have this capital already on hand.
Yeah, we're hearing that. And then in those cases, and we continue to advise those companies that our clients own shares in, that we own shares in as well, be patient. And I think the smart management teams are doing that. The cost of capital for the company B there has gone up. They want to be acquisitive as well. That's one of the avenues they grow. That's one of the avenues both these businesses grow. But cost has gone up, debt is already mounted, they're paying higher interest to service that debt. They get in a worse and worse position over time, whereas the other company is in a better position. Cipher's in a better position at this point. And they're sitting there and waiting out those valuations to come down to a range which makes sense for shareholders, where they can achieve that ROI, or a return on invested capital, that Aaron is talking about. And it's easier to achieve that when you're paying it out of cash. And particularly, like, there's some businesses we follow that are literally paying it out of internally generated cash flow. So you're never having to raise capital, increase that share count, and you're going out there and you're able to buy those businesses from cash, and it really makes an attractive return on invested capital.